So if you remember during the regional bank collapse, we saw bond prices basically shot up, the yields basically dropped quite rapidly, and bonds were trading in a sideways zigzag kind of formation. And now we're seeing bond prices sell off, sell off, sell off, and the yields start to pick back up again. Now, you may say that, hey, bond prices are coming down and yes, yields are going up, but that shouldn't, that should basically stop investors from investing in bonds because the prices are continuing to sell off. And at the same time, if prices are continuing to sell off, does that mean that we could see further continuation of the sell off in the bond market, further continuation of higher yields? And does that mean that, hey, everything is fine because this regional bank issue is basically done with? Or is it not? And what else does it mean in terms of investing in the markets when it comes to stocks and so on? But before I get into that, my name is Daniel. I run an organization called etfs that promotes financial literacy, teaches you about the macroeconomics and ties it in with stocks and bonds and commodities, currencies and crypto and so on. If you like such content like this, just subscribe to this channel. Check out our courses also on infovesting.com and you can find more details there. Now, the bond prices that are coming off and we're seeing sell off in bonds, especially the short end, is not stopping from a lot of investors still buying bonds and investing in bonds. Whether it is Abu Dhabi's firm, a royal firm, whether it's foreign investors, whether it's big investors out there or retail or small investors, people and other investors are hungry for yield, hungry for return, and also hungry for a safety net as well. With this whole debt crisis, right, that is looming, this whole issue with the regional banks and fears of recession, why not try to earn some sort of yield, higher yield, especially when you don't know where the markets are heading towards? Now, it may look like, hey, the NASDAQ is going back up, the stock market's going back up, let's buy stocks. Maybe it could cause few people to, say that, hey, we're back in a bull market. But the other investors don't think so, as they pile more into these treasuries, into these bonds to earn a guarantee of 4 or 5% when they're investing in this short-term fixed income products. Now, there's an article that comes out from the Financial Times. I'll link it in the description for you to read up on it. But it basically says, yield-hungry investors push U.S. money market assets to a record of $5.4 trillion. U.S. money market fund assets swelled to a record high this week as best yields available in years, and the early May collapse of the First Republic Bank kept investors piling into low-risk vehicles. Total net assets in money market funds, which invest in high-quality, short-dated debt, reached to $5.4 trillion as of Wednesday, according to the data from Investment Company Institute. The figure is up less than 5.3 trillion in late April and 4.8 trillion at the start of last year. Investors rushed into money market funds this year due to the increasing high yields on offer, particularly in government vehicles fueled by Federal Reserve most aggressive campaign interest rate rises in decades. So here's the thing, right? You could read up more in this article. They're piling into bonds because, one, they want to lock in those rates. That's one part of it. Second, needing the safety net, right? Because if you want to buy equities and take on that risk when you know what's coming down the pipeline in the future with this big recession and this crash, if you want to take on some risk, why not hedge it a little bit with some treasuries? Or why not just completely ignore that with buying treasuries and earn a guaranteed yield, right? Not all stocks are doing well, right? Just look at the Russell 2000 index. It's still underperforming, right? The bank stocks, same thing. The Dow, same thing. It's just NASDAQ that's on steroids that everybody thinks that this is the safe haven and it's safe from the banking crisis and the crash, which you could argue, sure, from a trading, tactical, strategic point of view, sure. But when and if credit conditions really contract and really seize up, everybody's going to be affected. It's simple as that. There's going to be job losses. You can't take out the same loans that you wanted to take out before. Your credit line completely contracts and so on. So there's going to be pain everywhere. And of course, certain stocks are going to really underperform compared to other ones out there, right? Just like we're seeing right now, the Russell 2000 underperforming, yet NASDAQ is outperforming and continues to rally and rally. But with that in mind, with the risks in mind, doesn't mean you start, chasing stocks. You could, mitigate that risk by investing in the treasuries out there. And those treasuries can help give you that cushion, that yield, and especially with bonds coming down and those yields creeping back up again, hey, why not lock in those high returns, those high yields, and profit from the situation? Now you may say that, hey, the prices are coming down. What else does that mean in terms of the fixed income market? Well, look at what the central banks have been communicating over the past few weeks, especially certain Fed members, maybe not all, but certain Fed members advocating that we're not done with the job with inflation. We may need to hike rates further. Bullard coming out and say, hey, we may need to go as high as north of 6% in terms of interest rates, right? So if data continues to do well, if the debt ceiling issue is resolved, right, and everything's coming back to normal, everything looks fine, there's the data is still strong and there's no crash that everybody's thinking, then guess what? The central bank is going to fight this with all that they have and continue to tighten until the rude awakening comes, until people start to realize, oh shoot, these rates at these elevated levels, the fact that banks are contracting credit, focusing on having more deposits in and lending less, is going to seize up the money, the credit in the economy. And it's that seize that when the credit, the blood of the economy stops, right? If your blood in your body, if your heart stops pumping blood, what happens to you? You fall on the floor, right? You're gone, you're dead, right? Same thing with the economy, the stock market, the real estate, the reason you're invested or maybe not or interested in investing in stocks and real estate and so on is because all this debt and credit that's being pumped into the system is what's giving it's the push. And until that push stops, until the blood stops, then the economy is going to drop and fall right on its face because the credit has just contracted so much, and it will get ugly and uglier, especially if the central banks continue, especially the Fed continues to hike rates further and further. So on the other hand, one point you could argue that investors are buying bonds because they fear the recession. The Abu Dhabi royal firm fears and betting that the crash is going to come, and at the same time, right, you're getting the yield. So not only the safety net, you're getting the yield because you see that a problem is coming down in the future. And yes, also the bond market is pricing in as the prices come down, the yields will continue to go up. As that happens, right, more investors will probably pile in, especially if rates continue to go up higher, will pile in to lock in those returns. And as the bond market sells off, it's also pricing in higher rates, higher tightening, which again goes back to the safety net. Go for safety. And that's why you see these record numbers in the treasury market. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.